Hello and welcome to Fidelity Connects, a Fidelity Investments Canada podcast, connecting you to the world of investing and helping you stay ahead. For a few years now, we've welcomed today's guest to our advisor-only live webcasts and are pleased to offer this discussion also as a video podcast. Carlos Cardone, Senior Managing Director of Investor Economics, sits down with host Pamela Ritchie to share his team's findings on the wealth management industry in Canada. This includes the latest trends shaping the industry so far in 2024, including the rising popularity of active ETFs and much more. Investor economics research is supported by a number of slides, so for those listening today, we encourage you to view this discussion on a platform that supports video podcasts, such as Spotify or YouTube Music, for the full experience. This podcast was recorded on July 3rd, 2024.
Welcome to you, Carlos. Happy summer. Great to see you.
Thank you. Happy to be here.
Yeah, great to have you here. You brought with you some slides to kind of describe some of the trends that you're seeing. And one of the broad ones is that savings ultimately are less than they were during the height of the payments in COVID from government coffers. Should we start there? We'll bring up the slide in a second, but just tell us broadly what we've seen over the course of the last couple of years.
Yeah. It's a positive story, negative story kind of mix. On one hand, we have some very positive growth in terms of assets. In 2023, we saw total investable assets in the Canadian market growing to $6.7 trillion. It's a new record high. It's 8% ahead of last year, but the bulk of that growth is connected to market effect. As you will probably see in the slide.
We'll bring that up now, slide 3. Yeah.
We put that on the screen. You can see that very clearly. I'm sure the audience is familiar with the story that we had extraordinary levels of savings during the pandemic at over $300 billion, which is easily more than double what you will normally expect in a normal year. 2022 maybe closer to a normal year at about $170 billion or so. And then look at the numbers for 2023.
Right.
$12 billion in net new savings for the household sector. That is basically the effect of the higher cost of servicing debt, inflation, of course, more money going towards consumption. There are entire sectors of the population, particularly what we usually call the mid-market or the mass affluent type of segment, that are finding it very, very hard to save in this environment. And actually, evidence, anecdotal evidence in many cases, but from banks, for example, that have a first row seating to money moving towards lending and all of that, they tend to see that some of these households are also kind of de-saving in some cases, basically to make ends meet, to lower the principal on a mortgage.
Okay, so that's that's the lead sentence out of what you're saying. I mean, the savings that are there, it's harder, first of all, but they're going to mortgage payments and other things too. But that's the big piece of it, and now you're seeing it. What are you seeing in 2024? We're halfway through. Some of your numbers will have come in, probably not all of them. What is the continuing trend?
So we continue to see some action in terms of GAC bookings. Certainly not as much as it was the case in late 2022 and early 2023. We are now seeing, of course, money going in other directions, and we have a couple of charts that look into investment funds and all of that. But fixed term deposits have been one of the main categories attracting money, at least for the last 2.5 years, when we started to see interest rates going up. Of course, that became the product of choice for many investors and also advisors. But more recently, into 2024, we started to see that the volumes of money going towards GICs have actually declined.
So let's put up the slide that it deals with some of this. Is the asset allocation story, slide 4. And as you say, so the GIC story was, and he says, was at the absolute peak of interest rates.
Yeah.
That's we have a rate cut here, so we're no longer there, it appears. Go into the ETF story for us a little bit.
So what's been happening in connection with investments during this period was that there was the substitution effect that was already in place during the pandemic, even before the pandemic, seemed to have been accelerating. And we are seeing more and more money going towards ETFs from multiple distribution channels. Good part of the reallocations of assets that happened over the last 3 years or so had ETFs as the destination. And in many cases, that money has been coming from mutual funds. In some other cases, of course, from direct securities. Mm-hmm. ETFs are doing a great job at replacing direct securities holdings.
So someone who just wants to buy a stock and have it in their portfolio.
Yes,
they'll go ahead.
Instead of stocks and instead of particularly fixed income allocations, that's a key area where ETFs have been very, very successful in attracting money that otherwise in the past was probably going more towards direct security allocations. There's also down pressure on mutual funds from the payout phase. Again, and not necessarily a new trend, but a trend that has been accelerating, right?
Is this a demographic story?
It's a demographic story.
Okay.
More people moving towards retirement. After the pandemic, I think we saw a very significant increase of the number of people going to retirement. And of course, what happens along with that is the depletion of portfolios and good part of these assets that have been accumulated in many cases for a couple of decades, if not more, are coming out of mutual funds. In fact, one of the main sources of net redemptions for mutual funds are funds that were launched at least 20 years ago or more. So a good part of what's attracting money in general in terms of investment funds are newer funds that were launched in the last few years. And of course, ETFs are a big part of that story. Right?
And within that story, sort of the passive versus active, what are you seeing there?
Yes, passive versus active is a very interesting, very particular story here in Canada that now is becoming more global. Canada was really a pioneer in the idea of the active ETF. And when we talk about active ETFs, we usually it's not an active passive only type of story. Within active, there are very clear degrees of activation of the strategies. That's something that has been developing in Canada over time. Very, very interesting. And when you look at the numbers, you see that at least half of the flows going towards ETFs are going to products with some level of activation.
So we're going to show some data on that in just a second. Let's go into sort of this investment fund net flows and ultimately where is it going?
Yeah.
I mean, geographically and also in terms of the asset class.
Yeah, we're seeing.
This is slide 5.
Slide 5. We're seeing a very, very significant change now into 2024. Number one, net new flows coming into investment funds have been increasing. As you can see very clearly in that chart, in 2024, the net redemptions for many products have been easing. The overall net result is more positive than it was in the last couple of years. But the probably more interesting part of the story is on the right side of that chart, where you can see very clearly that equities in an ETF format and in a mutual fund format are trending. If you put equities together through the first 5 months of this year, you have roughly $17 billion going towards US equities and global equity alone. Right. And then, of course, after that, you have this a continuation of trends that we saw shaping a couple of years ago. You have multiple fixed income asset classes, multi-sector, corporates, global, and many others that continue to trend.
Okay, fascinating how all of this is working. Let's go to slide 7 now and take 6 first of all. This is sort of the passive and active story. It's slide 6 and 7. And the dominant investment fund flows. So you're seeing flows from GICs into other things, but really it's a story about the active and passive that,
Yes.
that is receiving these flows.
Yes. We,
Tell us what we're seeing
when you look at the flows going into ETFs, of course, you continue to see some of the passive funds attracting money, but as you can see very clearly there, and this is not necessarily new, but it continues, of course, year after year, we see more money going towards funds with some level of activation. This, I mentioned before, it's a story that kind of started in Canada. Canada was really the first global jurisdiction to see more activity in active ETFs. And more recently, we also started to see this trend in the US, and it's shaping quite strongly also in the US. The chart on the right in that slide, as you can see, shows you that many of the active flavors that
Yes.
are trending are actually more popular with advisors than with self-directed investors. And this is, of course, very, very interesting on itself. It has a lot to do with the type of products that are becoming available. In many cases, of course, ETF companies are working to try to understand what advisors are doing, what could be replaced and made more effective with a product and all of that. And in many cases, of course, these products are being very, very successful, very well received by advisors in general. So the brokerage type of channel in particular is one of the key areas of growth for active type of funds.
Fascinating. Have we done both slides there? Is that 6 and 7? Or
So we have another
7.
slide, number 7, that shows a slightly different aspect of these funds, which is really connected to the level of activation of the strategies. I mentioned before that when we talk about active ETFs, we're not necessarily talking about fully active products. In some cases, it might be a strategic beta. It might be a quant model. It might be, for example, there's a category there called active income, which is primarily connected to the cover call type of funds, where the managers select a number of securities to write cover calls on and such. And then, of course, the fully active type of products. There's also a category that we call the active asset allocators, which are essentially the ETFs of ETFs, so ETF portfolios. And as you can see on the right side of the screen, that's the category that has resonated probably the loudest with self-directed investors in online brokerages.
Is that because it's usually a very balanced approach?
Yes.
And it's easier and maybe sleep at night, or
yes, it's balanced. It has automatic rebalancing towards the target. So if you buy, for example, into a balanced portfolio or a global equity portfolio, whatever it might be, the manager rebalances towards target very regularly. So you maintain the exposure and everything. And of course, as usually everything connected to ETFs, the pricing paradigms fit, I would say, quite well with the self-directed kind of environment, right? Relatively low prices, usually in most of these categories. Another area in terms of activation for ETFs where we see more product development and more money going in that direction are ETF share classes of existing mutual funds. In many cases, advisors, for multiple reasons, advisors are, of course, in many cases, changing their own business practices and the type of products that they use, and they're integrating more ETFs, as we know. And in many cases, of course, they want to continue to use mandates that they are familiar with, but if possible, in an ETF format rather than a mutual fund format. And this is something else that many companies have been launching and making available to advisors. And you can see on the right side of that chart that the bulk of the allocations connected to those products are also coming from the advice channels.
That's fascinating. And again, just going back to sort of the flows and where it's going to equity, U.S. equity particularly.
Yes. Yeah. U.S. equity is number one by far in terms of sales this year. If I remember correctly, the number is about $9.5 billion in net new flows. Now,
put that in perspective for us.
Put that in perspective, connected to, I think it was the second chart that we showed, with a total net flows for the industry of $20 $2 billion. So grab US equity, global equity, you're looking at pretty much 17 billion right there and then.
Wow.
Then, of course, you have as a counterparty to that, the next chart actually, as a counterparty to that, you have several categories, mainly balance type of categories, that have been in net redemptions and continue in net redemptions. But equities are back. No, not necessarily surprising. We usually tend to see that after a year like 2023, where we had some very positive market environment overall for equities, maybe a little bit concentrated on 7 big names, such as we know, but still many equity categories performed quite well. Now we see more activity, more money going in that direction.
So it's not just a story of the Magnificent Seven U.S. equity. It's broader than that.
Yes. You see a lot more than that actually trending in terms of allocations. It seems, a category, for example, that has not been doing particularly well in the last couple of years is dividend income paying type of equities. In this environment where you can obtain higher yields in some bond categories. That category has been kind of suffering over the last couple of years, but even more recently, we started to see some increases in terms of overall sales towards income-paying type of equities. And you can assume, I think, that in an environment where we will probably see in the mid to longer term lower interest rates, those are of course categories that, in terms of valuations, are going to benefit quite a bit.
It's a great question coming in here. So do you include, in the data that you're showing here, do you include segregated funds in mutual fund flows data?
Segregated funds are in part included in that data, as long as the segregated fund wraps an underlying mutual fund or ETF.
Okay.
That is these days.
Rather than what? Rather than
investing directly in the market. That is approximately 55+% of the seg fund industry that wraps an underlying product. So more than half of seg funds will be included there. Seg funds overall have not yet seen the type of recovery that we are starting to see with the broader investment funds market. Seg funds are still in net redemptions overall. It's a segment that is coming out of some regulatory change. Also, there were changes to the reserve requirements more recently, and all of that. I think in general there are expectations that that segment will be also coming back. But usually, seg funds tend to reflect trends seen in the broader industry a few months later.
I see.
So yes, it's not necessarily a leading indicator, it's more of a lagging indicator.
So we'll check back with you.
Yes.
Okay. Take us through the first home savings account and what that's represented overall, again, to sort of the allocation flows story and I guess ultimately how advisors are using it. I mean, obviously it's to save for a house, but how do you notice that sort of marching out?
So we produced earlier this year with end of the year data, we produced the first measurement of first home savings accounts in terms of dollars. Yes, we have a chart on that. $4.8 billion in just over 800,000 accounts that were opened during the period. The first round of account openings, I think for the most part, we've seen the bank branch system, the bulk of the accounts connected to that, and also some very significant activity in online brokerages. So given that this is catering to a younger audience, I think in general, the online brokerages were very, very quick to make these accounts available, and that also translating to some very positive results, as you can see in that chart. Now, what we are hearing in many cases from dealers is that your average advice-based type of dealer out there in the financial advisor channel, full service brokerages, are looking also into making these accounts available if they haven't already. And many advisors are very, very keen on having these accounts because they feel it's a good opportunity, it's a good excuse to connect in many cases to the next generation of their clients.
Okay.
I think that we know mainly from anecdotal evidence that, of course, the account owners, the account holders are relatively young people in most cases, but in many cases the accounts are funded, at least in part, by parents contributing to that and everything. So I think that bringing that into advice channels, making it part of the overall relationship with the client, and all of that is something that advisors in general see some opportunities there. And of course,
to connect with new clients,
to connect with new clients. It might bring, of course, new dollars into the mix, and then of course, think from the own perspective of the advisor. If you have a client that is contributing to the accounts of their children, sure, this might be money effectively moving in that direction. So if you don't offer the account, it might be certainly business that's going away from that particular advisor. But certainly a segment of the market where we expect to see more growth and more action from other dealers in the system to make these accounts available.
Okay, fantastic. So there's a slide on alts. Let's get into this. Liquid alts is something that actually we discuss quite often here. Take us through what you're seeing there in terms, again, allocations and the rise of liquid alts, but also the alts that are not liquid, the non-liquid, sort of everything from real estate, things that don't move.
Yeah. We did some research a few months back on the topic of alternatives here in Canada. And what we found for the most part is, number one, a lot of activity in terms of product launches, in terms of options becoming available to advisors, in-house, third-party type of products, companies from outside of Canada bringing capabilities to Canada. In many cases, of course, Canadian companies established already here, developing products in both categories, liquid alts and private alternatives. Allocations, for the most part, in most distribution channels are still relatively small, but growing.
Okay.
If you look at the last maybe year and a half or so, you see, in terms of asset classes, you see some liquid alternative type of asset classes ranking relatively high in terms of new money. Right now are the alternatives with some equity type of focus, long-short type of strategies, and such that are attracting quite a lot of money. A few months back, it was more connected maybe to private credit and others. So there's been some significant action there. Something that is really, really shaping, I think that advisors in general are going to see more of an offer from asset managers in terms of training. Okay. Training not only about the products themselves, of course, that's important and needed, but also probably more importantly, how to integrate these products in portfolio construction.
So this is the advisor training sort of their clients in a way, or educating their clients?
Of course. I think, you have the full link of, the asset management companies putting resources in the hands of advisors to educating, to work with them and all of that. And of course, advisors in that way being able to educate the clients in the benefits of alternatives in general. From what we've seen so far, interviews that we run with asset managers and dealers on this topic and everything, I'm pretty sure that you're going to see a lot more in terms of product development, particularly product development along the lines of products that look into solving the issues around liquidity of these products. I think this is something that's coming up from advisors loudly, that liquidity is very, very important. Of course, as we know, good part of the assets in Canada are in the hands of retirees or pre-retirees. Once you put these two segments together, you're looking at roughly 60% of all assets. So liquidity is certainly very, very important. It's something that most asset managers seem to be working towards. Of course, there are some issues with some of the private alts that are not necessarily liquid one way or another. Right. That's, of course, there. But I think it's something that we're going to see more on coming from asset managers in general.
One of the questions coming in is actually something I think we've spoken about before. What are you seeing in the emerging category of digital assets and investor appetite, flows, so on?
It's a very interesting story because, as you know very well, cryptocurrencies in particular, right? We had all these funds very early on in the previous cycle during the pandemic launching in Canada. Initially, a lot of money going into these products. Then, of course, came kind of the bear market for cryptocurrencies, right, and such. And then the story in the U.S. started to develop big time, right?
Yeah,
I think we started to see billions and billions of dollars moving into crypto ETFs in the U.S. and all of that. Canada didn't follow that to the same extent.
Okay.
Of course, with the recovery of valuations on crypto, we've seen a little bit more activity that was the case, say, 2 years ago or so, when that market pretty much collapsed in terms of valuations. But nothing remotely close to the story in the U.S. I think in the U.S., the fact that the product was new, that it was opening up access to a new category that, for the most part, had not been accessible to very large segments of the market, was certainly something that created the conditions for all that money to move around. But we didn't necessarily follow in that direction. Maybe another topic, unrelated, but maybe another trend where we're different from the US is ESG. Also, in terms of ESG, we saw that in the US, between political backlash and performance issues and all of that, ESG for the most part didn't attract any money for the most part for the last 2 years or so. Deep net redemptions in that category and everything, but that was not the case in Canada. We continue to see, to some extent, some positive flows into ESG, not as much as it was the case 2 years ago or so, when performance was much better overall, not only for the ESG category, but there are still some client segments in Canada that seem to be kind of keen in investing in these type of ESG strategies.
In terms of demographics, are they younger clients?
They are usually younger clients. We know that some advice-based type of dealers, it could be bank branches, some of the financial advisor networks, think that usually young couples with children, for example, are a very appropriate target for ESG to bring that up with them, but not only. In many cases, also people thinking about their legacy are also keen in investing in ESG. So there are spots of the market in different kind of demographics where you find an audience that might be open to invest in ESG type of strategies.
And one other thing I wanted to ask you about, this is just sort of again back to the flow story for funds rather that have had great performance. I mean, just sort of, I guess, decisions being made. And I don't think we have a slide on this, but it was something that we talked about in a previous session. Just a quick update on that.
That's an indicator that we follow closely. So something, just an example, you could be going through a very rough patch in terms of flows, in terms of performance, and all of that. But usually, when you start to see some meaningful activity in terms of net flows into funds that are highly rated among peers, and a common metric for that are the Morningstar ratings. You see funds with 4 or 5 stars in particular doing well in terms of flows in an environment in which not a lot of categories are necessarily doing well. That tends to be an early indicator that things are about to change. Right. And we documented that, and we started to talk about that, not necessarily implying that it was a trend already, but we saw that change about 3 months ago. Previous to maybe more of these trend towards U.S. equities and global equities that we started to see more recently. About 3-4 months ago, it was already visible that some of the higher performance, higher rated type of funds among peers, including in asset classes that were not trending at all in aggregate, some of these funds were attracting some money,
interesting.
and it's quite significant. It's actually quite significant. So in the first half of 2023, 5-star funds attracted just a few $1 billion. In the almost first half of 2024, we're now close at almost $15 billion.
That's a massive increase.
Going into these funds.
Fascinating. A great place to leave it on. Carlos Cardone of Investor Economics, thank you very much for joining us here in studio. Great to see you. Thanks for joining us. I'm Pamela Ritchie.
Thank you for listening to the Fidelity Connects podcast. If you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. Thanks again. See you tomorrow. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently, and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments.